Welcome to Topical Economics. If you are new here, don't forget to subscribe and hit the bell icon so you never miss any of our insightful videos on key economic concepts. In today's video, we're diving into the topic of fiscal policy. I'll be walking you through some past paper multiple-choice questions, carefully analyzing each one to explain why the correct answer is what it is. Whether you're preparing for exams or just want to strengthen your understanding of economics, this video will help you get to grip with important concepts in a clear and practical way. So, let's get started. Starting with first question. The chart shows a government spending in a year. What was the total government spending on public goods? A. $2,390 million. B. $5,050 million. C. $7,440 million. D. $33,940 million. Reference, 2022 May-June version 2. The correct answer for this question is option C. The total government spending on public goods is calculated as the sum of the spending on defense, which is $2,390, and law and order, which is $5,050. This gives a total government spending of $7,440 million. Moving to question 2. What is an example of a fiscal policy measure? A. Increasing the exchange rate. B. Reducing the power of trade unions. C. Reducing the rate of corporation tax. D. Setting a lower interest rate. Reference, 2022 May-June version 1. The correct answer for this question is option C, reducing the rate of corporation tax. Fiscal policy refers to government actions related to taxation and public spending. Reducing the rate of corporation tax is a fiscal policy measure because it directly impacts government revenue and the incentives for businesses to invest and grow. The other options are related to different areas. Option A, increasing the exchange rate, is typically a monetary policy tool, not fiscal policy. Next, option B, reducing the power of trade unions, is a labor market or regulatory policy, not fiscal policy. Lastly, option D, setting a lower interest rate, is a monetary policy tool, typically used by a central bank to influence economic activity. Moving to question 3. A government decides to increase the rate of growth of domestic production through expansionary fiscal policy. Which combination of measures will it use? A. Decrease the money supply and increase the rate of interest. B. Increase the money supply and decrease the rate of interest. C. Decrease taxes and increase government expenditure. D. Increase taxes and decrease government expenditure. Reference, 2022 February-March version 2. The correct answer for this question is option C, decrease taxes and increase government expenditure. Expansionary fiscal policy is designed to stimulate economic growth by increasing aggregate demand. This can be achieved by reducing taxes, which increases disposable income for consumers and businesses, thereby encouraging more spending and investment. Simultaneously, increasing government expenditure directly boosts demand through public sector projects, such as infrastructure development, healthcare, or education. Both measures work together to raise overall economic activity and promote domestic production. In contrast, the other options involve monetary policy or contractionary fiscal measures that would not support an increase in the rate of growth of domestic production. Moving to question 4. The table shows sources of government revenue for an economy. What is the total amount of tax revenue raised by direct taxes? A. $600 billion. B. $650 billion. C. $950 billion. D. $1,100 billion. Reference, 2021 May-June version 3. The correct answer for this question is option B. To calculate the total amount of tax revenue raised by direct taxes, we need to focus on the taxes that are directly levied on individuals and businesses, which typically include tax on employment income, income tax, tax on inherited wealth, inheritance tax, and tax on company profits, corporate tax. Tax on employment income equals 500. Tax on inherited wealth equals 50. Tax on company profits equals 100. Thus, the total amount of tax revenue raised by direct taxes is $650 billion. Moving to question 5. What is fiscal policy? A. Government decisions on money supply and interest rates taken to influence total demand. B. Government decisions on spending and taxation designed to influence total demand. C. Government measures designed to influence total supply in the economy. D. Government regulation of the foreign exchange rate to influence imports. Reference: 2021 May-June version 3. The correct answer for this question is B. Government decisions on spending and taxation designed to influence total demand. Fiscal policy refers to the use of government spending and taxation decisions to influence the overall demand for goods and services in the economy. By adjusting tax rates and government expenditure, a government can either stimulate or slow down economic activity. For example, increasing government spending or cutting taxes can boost demand and economic growth. Expansionary fiscal policy, while decreasing spending or raising taxes can help reduce inflation or control an overheated economy. Contractionary fiscal policy. The other options which are given refer to different economic tools. Option A refers to monetary policy, which involves decisions on money supply and interest rates, typically managed by a central bank. Next, option C is related to supply-side policies, which focus on improving the productive capacity of the economy. Lastly, option D refers to exchange rate policy, which is part of a country's broader trade and monetary policy, not fiscal policy. Moving to question 6. A government's revenue grew 8% to $3.25 trillion. Its expenditure was reduced to $3.69 trillion. What can be concluded from this? Reference: 2021 May-June version 1. The correct answer for this question is option B. The government's revenue grew by 8%, reaching $3.25 trillion, while its expenditure was reduced to $3.69 trillion. Since expenditure exceeds revenue, the government is running a deficit of $0.44 trillion, or $440 billion. In this situation, the government's policy aim would likely be to reduce the deficit. To achieve this, the government could focus on increasing revenue through tax hikes or other measures, or it could reduce spending. Therefore, the most appropriate conclusion is that the government is running a deficit and its aim is to reduce the deficit. Moving to question 7. An economy has a high rate of inflation. In response to this, its government increases income tax. What is the most likely reason for this increase? A. To discourage the consumption of harmful goods. B. To raise money for government spending. C. To redistribute income. D. To reduce total demand. Reference: 2021 May-June version 1. The correct answer for this question is option D. To reduce total demand. When an economy is experiencing high inflation, the government may increase income taxes as a way to reduce total demand in the economy. Higher income taxes leave consumers with less disposable income, which generally leads to reduced spending on goods and services. Since inflation often occurs when demand outstrips supply, reducing overall demand can help ease inflationary pressures by lowering the demand for goods and services, helping stabilize prices. While the other options are related to different policy objectives. Option A, to discourage the consumption of harmful goods, is more aligned with specific sin taxes or targeted taxation policies, not a broad response to inflation. Next, option B, to raise money for government spending, could be a reason for increasing taxes in other circumstances, but in the case of high inflation, reducing demand is typically the primary goal. Lastly, option C, to redistribute income, is a possible reason for increasing taxes, but it is more relevant to social equity objectives rather than controlling inflation. Moving to question 8. What is a fiscal policy measure? A direct tax. Exchange rates. C. Interest rates. Deregulation. Reference: 2021 May-June version 2. The correct answer for this question is option A, direct tax. A fiscal policy measure involves the use of government spending and taxation to influence the economy. Direct taxes, such as income tax or corporate tax, are tools of fiscal policy because they directly affect household and business income, which in turn influences consumption and investment levels. The other options are not fiscal policy measures. Option B: exchange rates are influenced by monetary policy, particularly by central banks and foreign exchange markets, not fiscal policy. Next, option C: interest rates are set by a country's central bank and are a tool of monetary policy, not fiscal policy. Lastly, option D: regulation refers to legal or administrative measures that may impact businesses and industries, but is not a direct fiscal policy tool. Moving to question 9. Tax is charged at 1.45% on all wages earned to pay for basic medical provision. How would this tax be described? A. Direct and proportional. B. Direct and regressive. C. Indirect and proportional. D. Indirect and regressive. Reference: 2021 February-March version 2. The correct answer for this question is option A: direct and proportional. This tax is direct because it is levied directly on individuals' wages, meaning it is charged based on income rather than on goods or services consumed. It is proportional because the tax rate, 1.45%, is constant across all income levels. Everyone pays the same percentage of their wages, regardless of how much they earn. A proportional tax means that the tax rate remains the same, regardless of the income level, which is different from a regressive or progressive tax. A regressive tax would mean that the tax takes a larger percentage of income from lower earners than from higher earners, which is not the case here, as the tax rate is uniform. Thus, the tax is described as direct and proportional. Moving to question 10. What is included in a government's budget? A. The balance of government revenue and government expenditure. B. The balance of export revenue and import expenditure. C. The difference between investment and saving. D. The difference between social benefits and social costs of production. Reference: 2021 February-March version 2. The correct answer for this question is option A: the balance of government revenue and government expenditure. A government's budget outlines its financial plan for the year, detailing expected revenues, such as taxes and other income, and expenditures, such as spending on public services, infrastructure, defense, and social benefits. The balance of revenue and expenditure is crucial, as it determines whether the government will run a budget surplus, revenue exceeds expenditure, a deficit, expenditure exceeds revenue, or be in balance, revenue equals expenditure. The other options are not directly related to the government's budget. Option B: balance of export revenue and import expenditure, refers to the trade balance, not the government's budget. Next, option C: difference between investment and saving, refers to economic concepts in the context of national income and financial markets, not a government budget. Lastly, option D: difference between social benefits and social costs of production, relates to the concept of economic welfare or cost-benefit analysis, which is not typically included in the government budget. Moving to question 11. The diagram shows selected areas of government spending for a country. What was the total government spending on merit goods? A. $32.2 billion. B. $81.8 billion. C. $118.2 billion. D. $261.9 billion. Reference: 2021 February-March version 2. The correct answer for this question is option C. The total government spending on merit goods will be the sum of government spending on education and the government health. From the diagram we see that the government spending on education is $36.4 billion, and the government spending on healthcare is $81.8 billion, adding $36.4 billion and $81.8 billion, gives the total government spending as $118.2 billion. Moving to question 12. The table shows a government's receipts from taxation. What is the total amount of revenue raised by direct taxes? A. $280 million. B. $700 million. C. $730 million. D. $950 million. Reference, 2020 Specimen Version 1. The correct answer for this question is option B. To calculate the total amount of revenue raised by direct taxes, we need to focus on the taxes that are directly levied on individuals and businesses. In this case, the direct taxes are income tax on individuals' earnings, tax on company profits, corporate tax. From the table, the amounts are: income tax equals 600 million. Tax on company profits equals 100 million. So, the total revenue raised by direct taxes is 600 plus 100 equals 700 million. Thus, the correct answer is B, $700 million. Moving to question 13. Due to a rise in the number of retired people, there has been increased demand for some government expenditure. Which type of government expenditure is most likely to be directly affected? A. Defense. B. Health services. C. Retraining grants. D. Street lighting. Reference, 2020 October-November version 3. The correct answer for this question is option B, health services. As the number of retired people in an economy rises, there is typically an increased demand for health services due to the growing need for medical care and support associated with aging populations. Older individuals are more likely to require healthcare, long-term care, and medical treatment, which puts pressure on government expenditure in this area. The other options are less directly affected by an aging population. Option A, defense. While government spending on defense is important, it is generally not directly influenced by the number of retired people. Next, option C, retraining grants. These are often aimed at workers who are displaced in the labor market, so while they might be relevant for younger workers, they are less likely to be directly affected by an increase in retirees. Lastly, option D, street lighting. Type of expenditure is typically related to infrastructure maintenance and is not closely linked to demographic changes, such as the number of retirees. Moving to question 14. A government decreased the tax on all goods produced in its country. What is the most likely consequence of this? A. A decrease in exports. B. An increase in imports. C. An increase in production. D. A worsening of the balance of trade in goods. Reference, 2020 October-November version 3. The correct answer for this question is option C, an increase in production. When a government decreases the tax on all goods produced in its country, it effectively reduces the cost of production for businesses. This can lead to an increase in production, as companies are incentivized to produce more goods due to lower tax burdens. The reduction in tax may also make domestically produced goods cheaper, potentially increasing demand within the country. Analyzing the other options. Option A. A decrease in exports. Lower taxes on domestic goods typically make those goods more competitive, potentially increasing exports rather than decreasing them. Next, option B. An increase in imports. The tax reduction on domestic goods doesn't directly affect imports. In fact, if domestic goods become cheaper and more competitive, it could reduce imports, not increase them. Lastly, option D. A worsening of the balance of trade in goods. While a reduction in tax could lead to increased production and potentially more exports, it could also make domestic goods cheaper and thus encourage more consumption of imports. However, this is less certain than the direct impact on increased production. Moving to question 15. The table shows the tax that an individual would pay at different levels of disposable income. Which type of tax is shown in the table? A. Corporation tax. B. Indirect tax. C. Progressive tax. D. Regressive tax. Reference, 2020 October-November version 2. The correct answer for this question is option C, progressive tax. Is one in which the tax rate increases as the taxable amount, in this case, disposable income, rises. The table shows that as an individual's disposable income increases, the tax they pay also increases. For example, at a disposable income of $10,000, the individual pays $2,000 in tax, and at $30,000, the tax increases to $6,000. This pattern, where the tax liability grows as income grows, is characteristic of a progressive tax system. In a progressive system, higher earners pay a larger proportion of their income in taxes compared to lower earners. The other options, such as corporation tax, indirect tax, and regressive tax, do not fit the description, as corporation tax applies to businesses, indirect taxes are levied on goods and services, and a regressive tax would reduce the relative tax burden as income increases. Thus, the tax in the table is best described as a progressive tax. Moving to question 16. Which measure would indicate that an expansionary fiscal policy is being used by the government? A. Cuts in government spending. B. Higher interest rates. C. Lower interest rates. D. Lower taxes. Reference, 2020 October-November, version 1. The correct answer for this question is option D. Lower taxes. Expansionary fiscal policy is designed to stimulate economic activity by increasing aggregate demand. One of the main tools of expansionary fiscal policy is lowering taxes. By reducing taxes, the government increases disposable income for households and businesses, which encourages higher consumer spending and investment. This boost in demand can help stimulate economic growth, especially during periods of recession or economic slowdown. Analyzing the other options. Option A. Cuts in government spending would be a contractionary fiscal policy designed to reduce demand in the economy and control inflation, not an expansionary policy. Next, option B. Higher interest rates would be a contractionary monetary policy measure, typically used to reduce inflation by making borrowing more expensive, which reduces spending and investment. Lastly, option C. Lower interest rates. While lower interest rates are part of expansionary monetary policy, they are not part of fiscal policy. Expansionary fiscal policy focuses on government spending and taxation. Moving to question 17. When is the budget described as balanced? A. When direct taxes and indirect taxes are equal. B. When exports and imports are equal. C. When government spending and government revenue are equal. D. When the demand for money and the supply of money are equal. Reference, 2020 May-June version 1. The correct answer for this question is option C. When government spending and government revenue are equal. A balanced budget occurs when the government's total spending is equal to its total revenue, such as taxes. This means that the government is not borrowing money, and it is neither running a surplus, where revenue exceeds spending, nor a deficit, where spending exceeds revenue. The balance in the budget reflects fiscal equilibrium, where the government's income and expenditure are aligned. Analyzing the other options. Option A. When direct taxes and indirect taxes are equal, refers to a specific comparison of tax types, not the overall balance between spending and revenue. Next, option B. When exports and imports are equal, describes a balanced trade situation, not a balanced budget. Lastly, option D. When the demand for money and the supply of money are equal, relates to the money market, not the government's fiscal balance. Moving to question 18. A government has a contractionary fiscal policy to reduce inflation. What will the government increase? A. Expenditure on infrastructure. B. Income tax rates. C. Personal tax allowances. D. Unemployment benefits. Reference, 2020 May-June version 3. The correct answer for this question is option B. Income tax rates. A contractionary fiscal policy is designed to reduce inflation by decreasing aggregate demand in the economy. One of the main tools used for this is increasing income tax rates. By raising taxes, particularly income taxes, the government reduces the disposable income of individuals and businesses, leading to less spending and investment, which helps to cool down inflationary pressures. Analyzing the other options. Option A, expenditure on infrastructure, is a form of expansionary fiscal policy, as increased government spending on infrastructure stimulates demand and economic growth. This would not be used to reduce inflation. Next, option C, personal tax allowances, when increased, would leave individuals with more disposable income, which could actually increase demand and exacerbate inflation. This is not in line with contractionary policy. Lastly, option D, unemployment benefits. Increasing unemployment benefits would increase government spending and provide more income to individuals, which could increase demand, not reduce it. Moving to question 19. What is not included in public expenditure? A. Capital spending by firms. B. Interest payments on government borrowing. C. Investment in defense by the central government. D. Subsidies to bus companies from local government. Reference, 2020 May-June version 1. The correct answer for this question is option A, capital spending by firms. Public expenditure refers to the spending undertaken by government entities, such as the central government, local governments, or public sector organizations, on goods, services, and investments that benefit the public. This includes spending on things like defense, infrastructure, social welfare programs, and servicing government debt. Option A, capital spending by firms, is not part of public expenditure because it refers to investment by private businesses in capital goods like machinery, buildings, and equipment, which are private sector expenditures, not government spending. In contrast, the other options, interest payments on government borrowing, investment in defense by the central government, and subsidies to bus companies from local government, are all examples of public expenditure. These involve government spending either to pay off national debt, fund public services, or support key industries for the public good. Therefore, capital spending by firms is the only item listed that does not fall under the category of public expenditure. Moving to question 20. The government wishes to increase economic growth in its economy. What would not be likely to achieve this aim? A. The central bank encourages bank lending. B. The central bank lowers interest rates. C. The government increases sales tax, VAT. D. The government subsidizes new industries. Reference, 2020 May-June version 1. The correct answer for this question is option C. The government increases sales tax, VAT. Would likely reduce economic growth rather than increase it. Higher sales taxes raise the cost of goods and services for consumers, which typically leads to reduced consumption and demand in the economy. Since consumer spending is a key driver of economic growth, higher taxes can dampen economic activity and slow down growth, especially if the economy is already facing challenges such as low demand or inflationary pressures. In contrast, the other options are likely to promote economic growth. Option A. The central bank encourages bank lending, making credit more accessible to businesses and consumers, which can stimulate investment and spending, leading to higher economic growth. Next, option B. The central bank lowers interest rates, making borrowing cheaper for businesses and consumers, encouraging investment and consumption, which can boost economic growth. Lastly, option D. The government subsidizes new industries. Here, subsidizing new industries can stimulate innovation, job creation, and investment, which can foster economic growth by expanding productive capacity and diversifying the economy. Moving to question 21. A government increased revenue by increasing taxes on firms. Which tax did it increase? A. Inheritance tax. B. Profits tax. C. Sales tax. D. Value-added tax. Reference, 2020 May-June version 2. The correct answer for this question is option B, profits tax. When a government increases revenue by raising taxes on firms, it is most likely increasing the profits tax, also known as corporation tax. This tax is levied on the profits that businesses or firms make. By increasing this tax, the government directly targets the earnings of companies, thereby raising its revenue. Analyzing the other options. Option A, inheritance tax, applies to the transfer of wealth after an individual's death, not to the profits or earnings of businesses. Next, option C, sales tax, are typically levied on consumers when they purchase goods and services, not directly on firms' profits. Lastly, option D, value-added tax, VAT, is a consumption tax paid by consumers when they buy goods and services. While businesses collect VAT on behalf of the government, the tax itself is not directly levied on firms' profits. Thank you for watching this video. I hope the explanations of past paper questions and the reasoning behind the correct answers helped clarify some key concepts. If you found this video useful, please don't forget to like, comment, and subscribe to Topical Economics for more insightful lessons and exam tips.